Please, can you all hear me?
Yes, we can hear you loud and clear.
Subhanallah, network number. Okay, perfect. All right, today's session is in fact a very important one, and I believe both both the newbies and intermediaries have so much to take. Just a moment, please. I keep remembering stuff, so I'm really sorry. Honestly, I'm not much of a planner. I can't sit down and plan your classes. Honestly, I can't do it. I just like doing stuff in front. That's why I will try as much as possible to talk about all of these: accumulation, manipulation. Please, very like kill manipulation. Distribution. Listen, you can't afford to attend today's session and not attend tomorrow's session, or attend yesterday's session and not attend tomorrow. Nothing is promised, nothing is guaranteed, and I wouldn't want you to miss a single thing. So I think we call this elements to a trade setup. I don't know. Yeah. I will try and explain it. I told you that's the intention of this bootcamp, to expose you to a number of things. So when you forge ahead with your journey, most of these things you've heard of them before, and that will make it very, very much easier for you to further your journey, so to speak. So yeah, we call these elements. Don't worry, I'll try as much as read. Yeah, just a minute. Please, just a minute. Just a minute. I'll try as much as possible to touch briefly on all of these things. Time and price theory. What again? What again do I need to include? Time and price theory. Yeah. So let me try to reduce. Yeah, well, I have consumed the entire page, and that's not what I would want. Just a minute, please, just a minute. I should try to do this before. Honestly, they just come to my head. So it's not like I can pre-plan them. Even if I say I would pre-plan this whole session, I can't do it. I know I won't. So bear with me. Yeah. So as a trader, just understanding how these works, using the aforementioned to build up a narrative, a trade narrative. Yeah, let's leave it at that. English want to kill me. So the aim for today's session is how to use the aforementioned here to build a trade narrative, and of course, a bias. Let's call it a bias or whatever. Once you have an understanding of these, because it's very difficult to escape, it's very difficult to find a situation where the market would fail to respect either of these in whichever trading day. Or rather, let's have a long-term perspective to it by saying in whichever trading week. So if you have a good understanding of these and you know how to utilize these, it's going to be very difficult to go to expend a week in the market without finding an opportunity to utilize these in your trading. Well, it's possible to um, find an opportunity almost with the daily cycle, please. Just a moment, just a moment. All right. Yeah, I will talk about CHBO. Yeah, definitely imbalances. All right, I should include that. Definitely. Yeah, when I spoke about price action market structure, I intend to talk about that. But yeah, let's talk about it also. Um, daily cycle. Please, just a minute. This is a master class that I could charge with whichever amount I would want to charge for. Honestly, daily cycle. Yeah, price action is a market structure. Is a price action. Um, Other blocks and imbalances. Please, just a minute. Other blocks slash imbalances. I will show you all of these things on a chart today, God willing. You will see all of these things today. Every single thing I will show you. Please, if someone can record this session, I'd really appreciate it because today's session is in fact a day one to me, a masterclass. I hope it lives up to its hype because I keep hyping today's session. I hope I don't fumble. Yeah, all right. Now, my aim is to help you utilize these aforementioned bullet points in building up a trade narrative. As a trader, I told you there are countless approaches, countless systems as to how you can approach the market and take advantage of what the market has to offer. I told you about the caliber of market participants we have. There are different ways to differentiate market participants, either by equity. So if you have so much money, just like the government, we could call you an institution, equity or equity intention, let's say orientation. Orientation or style of trading. These are, so yeah. So the motive behind today's session is simply how to help you guys use the aforementioned bullet points in building up a trade narrative. As traders, we not only analyze to buy or sell, we also analyze to wait. Okay. As traders, we don't just buy or sell. We also need to understand how to identify opportunities and how to identify no opportunities. Okay, how to literally look at the charts and say, I think I should stay away. So that's also trading. People tend to misconstrue trading by simply reducing it to the act of buying or selling. That's not really, majorly, it's about being able to filter through trade setups, being able to filter through trade situations, and tell yourself this is not worth the risk. Okay, this is not worth the risk. There's something we call back testing and forward testing. Testing. Please, I'm very sorry for rambling out and going. These things keep coming to my head, so I don't have a module teaching back testing, forward testing. The intention of this bootcamp is to equip you with the know-how to further your journey, the know-how to not be absolute strangers in the game. So yeah, there's something we call back testing and forward testing. Back testing would give you an understanding of how the market operates, how the market moves. Forward testing would help you understand how you react, how you respond to how the market moves and how the market operates. So how to backtest is simply you choose a certain instrument that you prefer to trade. You switch through multiple time frames, try to see how price reacts to your point of interest. I will teach you how to identify point of interest. If you trade chart patterns, try to identify chart patterns, where they form, how they form, when they form, how they tend to play out. So that's all a form of backtesting. Okay, that's all a form of backtesting. And then the forward testing is to trade a live market, either using a demo or a live account, to then look out for those setups that you've backtested and build confidence on. Okay, so let's assume this is a let's say 1, 2, 3. Let's call this head and shoulders. Yeah, let's call this a head and shoulders, for instance. I don't trade chart patterns. I don't really know how they form. Let's say this is a shoulder. No, this is not a head and shoulder. Let's say this is a triple top. Honestly, I don't really know what chart pattern this is, but because I don't trade patterns. But yeah, let's say this is a triple top, and you've backtested triple tops. You've understood how they form, and you found a way to take advantage of them. You've journaled. So you go to a live market and you try to watch out for POIs that a triple top or triple bottom would fall. For those just hearing about triple tops or triple bottoms, just calm down. I told you there are countless ways of approaching the market. Personally, I don't use chart patterns. If they work, every single approach works. So sometimes it has to do with your personality, with what you have a good understanding of. Okay. For those that use pure price action, one could tell you, well, this is a beautiful key level. Someone would call it a key level, someone would call it a supply zone. Just a minute. This is a new um, TradingView account. I opened it just now, honestly. So I really don't know how these where these things are. The tools. Oh God, fuck. There's a rectangle. Please just a minute. Well, let me just use the way button. Now, let's say this is a supply zone. Please, what the fuck, dude? Please just a minute. This is a new TradingView account. I just opened it just now. That's why it's giving me headache. Yeah, this is what I'm looking for. Now let's say this is the supply zone. Some would use now this is the blue ray. I did speak about the tools we shall be using. If you just a minute, just a minute. The system is heating up now. I did write trading tools here. I told you I will try to help you put together all of these concepts and how to use them to trade. I did write a supply and demand zone here. Where is it? Yeah, yeah, supply and demand zone. Now these are types of POIs. One of our biggest problems as traders is we tend to use language to confuse ourselves. Now, someone would look at this and say this is a supply zone. Someone would look at this and say this is a resistance. So it doesn't really matter. So ultimately, when price came back to this supply zone, I'll tell you how to look at a supply zone and identify that this is a supply zone. And this is in fact a worthy supply zone. Don't just calm down. Just calm down. Now, when price came here, we saw wick rejections. I told you about the psychology of candlesticks, how candlesticks form, why they form, and when you see them form, what they are actually saying. Now, there is a saying, trend is greater than candlesticks. So using trend to make trading decision is much. Please, I'm looking for the greater sign. Where's the greater sign? Okay, here it is. Trend is greater than candlestick. Candlesticks. Trend is greater than candlestick. I'll tell you what I mean. Okay. Just a minute. Now, Just a minute. Okay. When I told you about the engulfing, candle, and what you see here, this is a bullish candle engulfing the bearish candle. And of course, the bullish candle is a signal that a bullish engulfing candle is a candle signaling bullish strength. Okay, buyers are really, really present. But then you have to put in context, there are so many things that you have to put in context, not just singling out candlesticks to make decisions. Now, this is a bullish engulfing candle, this here. But right after the bullish engulfing candle formed and closed, another bullish candle formed and closed. Guess what happened? The market came down. So, well, you could say, I told you, whenever you see a bullish engulfing candle form and I bought and then the market came down. So there's context to it. But if you come down here, this is a bullish engulfing candle that formed. But then after which it formed, guess what happened? The market continues spiraling up. So you can't just single out candlesticks and make your trading decisions. You have to put in zone at which price is. Okay, the zone at which price is, what your bias is, what you've developed as a bias using trend and other price to make your trading decision, to build up a narrative. Now, this is a set I wouldn't have missed for the world. This is a trading opportunity that I wouldn't. Personally, I told you I like catching reversals. What I mean by reversal is, just a minute, my system is heating up. I don't know why. Fuck. Just a minute. Like, this is the new trading view account. It's giving me headache. Kai, please, just a moment. Live system is really, really heating up. I don't know, whenever I on trading view, I find problems. Let me just go back there. Guys, just calm down. Things will make sense now, God willing. Okay. Before I deviate, because I will talk about this and I'll jump into that, but just have this at the back of your mind. Trend is greater than candlesticks. I hope this is the way to spell candlestick. Using trend to make your trading decision is far better than singling out candlesticks. Candlesticks do have their place in building up a narrative and building up a bias and making a trading decision. But yeah, the first thing to put in mind is trend, and then you mark out your POIs, which I shall show you how to do, and then you watch out for candlesticks formation around that POI, and then you make your trading decision based on that. All right. Now, I did remind you of market participants, and I told you there are a number of markers we use to distinguish between them. We could use equity to distinguish between market participants. We could use, let's say, orientation or intent. Orientation or intent or intent. What do I mean by that? Well, if you are in the game to make profit, there's no way we would refer to you as a, well, they are all institutionals, but then we definitely have to classify you as a commercial participant. Okay? And then, of course, there's style. Style, what I mean by style is I told you there are swing traders, there are day traders, intraday traders, there are scalpers, there are position traders. I did differentiate to you what they mean. When we classify you as a position trader, normally institutions, people that are not in the game to make profit, normally are the ones that take positions that last for years. Why do they do that? Well, they normally do that to control inflation, to control other macroeconomic um, markers or fundamentals that could mess with their economy. So they tend to enter the market to stabilize their economy, either by hedging. God, I didn't tell you about hedging. Excuse me. I didn't tell you about hedging the other day. Hedging. Now, hedging is simply when you take both positions. We have only two positions in the market. You could either buy or sell. So when you buy and sell at the same time simultaneously, you are literally hedging. You are hedging. buy, and sell. Retail traders like you and I also consider hedging as a form of risk management, because when, let's say you are in a losing trade and your account keeps going red, you bought, but then you happen to be wrong, your account keeps going red, market continue to sold, to sold, to sell. Let's say you bought and then the market goes against you and then it dipped, it's sold. So you could take a sell position to hedge against your buy position. Okay, especially when you are a trader that trades for investors. Okay, so when their money is in red, you could decide to hedge your positions and you call them. You tell them what's really happening. There's a problem. You guys are currently in a drawdown. What do they think? Should you close the positions or should you hedge and calm down until you finally decide and find a way to make up for the drawdowns? What that means is you bought, but then the market sold, and this is your entry, but you didn't use stop loss, or you have a very wide stop loss. So market is currently approaching your stop loss, but then you don't want to close because you are hopeful the market would retrace and will keep going back up. So instead of closing on that buy trade that is currently in red, you sell. So just in case the market continues to go down, that sell will mitigate your loss on the buy position. So that's what they call hedging. You could look it up later. You could look it up later. Now, why I raised the issue of market participants is because I want to talk to us about time frames. We are yet to speak about time frames because why I chose to not include time frames in our previous conversations is because I've seen how time frames confuse so many people. Starting out time frames, switching through multiple time frames was also a big problem to me until God helped me. God helped me and I just deciphered the science behind time frames. It's really beautiful. I'll give you a very quick example. There are certain things we call the Russian dolls. Russian dolls. Is there anyone here that knows the Russian dolls? Is there anyone here that knows the Russian dolls? Someone should record and send to the group afterwards. Are we talking about everything in the chat? Yeah, mom, you would go to the chats. Goodness God. We will. We will. We will go to the charts. Does anyone here know what a Russian doll is? All right. Please, is anyone recording the session? Is anyone recording the session, please? Is anyone recording the session? Please, is anyone recording the session? All right. Thank you. Thank you. Please, just a minute. I'm replying a text. Just a minute. All right. Isn't it only the host who can? No, you could use your screen recorder and record it. You could use your screen recorder and record. I really don't want to fill up my. Yeah. So these are Russian dolls. When thinking about time frames, these are Russian dolls. let them open up. Just a minute, just a minute, just a minute. Now, if you could remember here, I told you we have higher time frames and we have lower time frames. If we come back to these, what you see here is we have the higher time frame, higher time frame, higher time frame doll, higher time frame, medium time frame doll, lower time frame doll, lower time frame doll, lower time frame doll. But in essence, they are all the same thing. They're all the same thing. Same applies to time frames. Same applies to time frames. Now, if this is the 4-hour time frame, this is where you switch through time frames. And the 4-hour time frame is considered to be the median time frame, regardless of who you are in the market, whether an institution or a commercial trader or a retail trader. Everyone looks at the 4-hour. So 4-hour is a very, very good place to make your trading decision from. Now, whenever I come to this trading view, my system heats up. That's why I quickly leave the trading view page. Just different view. Yeah, it's the same thing, but it just comes to you in a different view. Because the higher time frame tends to be bulky and rather less noisy. The lower time frame, since it's just a miniature of the higher time frame, it would seem to you with so much noise, it would come to you with so much noise, and you'd be confused to an extent if you don't know how to navigate through the time frames. So we'll pick up a time and we go through multiple time frames, and I'll help you understand how they are all the same. How they're all the same. Now, what top-down analysis is there's something we call fractal nature of price. Okay, fractal nature of price. Fractal is just an English term that means something like the Russian dolls. What is happening higher on the higher time frames is just the same thing as what is happening on the lower time frames. Or rather, what is happening on the lower time frames is simply trying to complement what is happening on the higher time frames. But the lower time frame tends to have lots of noise. It tends to have what we call complex pullbacks. So if this is an impulse, and this is a correction, and this is an impulse, and this is a correction, if you come to a lower time frame, it wouldn't, okay, very quickly, this is very, very important. If this is an impulse, and this is a correction, and this is an impulse, and this is a correction, and this is an impulse, this here is what we refer to as a trading range. This here, and this here. Okay, so when conducting your high time frame analysis, or rather top-down analysis, you start from the high time frame, and then you identify your trading ranges, your high time frame trading ranges. Because that will help you identify the important structures when you switch through time frames. Because when you switch through time frames, the market structure tends to change. I'll show you very quickly. If we come here, can you see that this is an impulse to the upside? This here, this is an impulse to the upside. A single move, boom, upwards. But please let me change to time frame and tell me what you see. Just a minute, it's loading up. Please look at this. Don't you see more? Just look at this. Please just look at this. If you could remember, on the 4-hour time frame, this was just a single move. This here was a single move. This here was a single move, boom, upwards. But when I came to a lower time frame, please, what do you see? You see lots of upward moves, downward moves, upward moves, downward moves, lots of noise. I hope I'm making sense. You see lots and lots and lots of noise. We go up, we go down, we go up, we go down, we go up. But when I came to the higher time frame, the 4-hour time frame, or rather the median time frame, Just look at this. It was a what? It was a single move, just an impulse. Poop, poop, poop. So same applies to the Russian doll example. It's all the same pin, but it comes to you in a different way with so much noise. When you go to the lower time frame, it's the same thing, but it comes to you with so much noise, unnecessary um, structures. So since I told you the importance of high time frame structural points, I told you what you do is you come to the higher time frame, you identify structural points on the higher time frame, and then you try to come down to a lower time frame and understand that everything you see within the structural point is just noise. This isn't how I analyze. I'm just helping you guys understand something, but this is definitely not how I analyze. Now, to come back to my concept of POIs, this here is what we call a resistance, a support turned to a resistance. We haven't reached there, but I just want to help you guys understand something. So since this here is a high time frame structural point, this here is a high time frame structural point, this here is a high time frame structural point, this here is a high time frame structural point, this here is a high time frame structural point. So as a wise guy, personally, what I do is I identify high time frame structural points and I wait for price to approach those structural points and take trades based on that. Now, if this is a structural point, or rather POI, that I intend to see what price do around this POI before I take a trade, this is where the concept of BRC comes in. Break, retest, continuation. Now, if this zone gets respected, it only means that we would have a push to the upside, then continuation. So I'm taking a pro-trend trade. Pro-trend trade. Because what is the trend? The trend is clearly bearish. The trend is clearly pushing to the downside. Just look at this. The trend is clearly bearish. Clearly the price is pushing market downwards. Okay, so everything I intend to do I should make sure coincides with the trend if I want to find myself at a safer end. It's possible to take a counter trend trade. It's possible to take a counter trend trade. But the safest thing to do is try to identify the trend and follow the trend. I told you it's like finding yourself at the ocean or river and then saying you want to go against the tide. It's not a wise thing to do. Now, if this is a high time frame structural point, the power of identifying high time frames, there are many strategies, but this is a beautiful one. Well, first we've identified the trend. The trend is clearly going down, bearish, on a high time frame. So the next question we need to do is, how can we identify higher time frame structural points that would give us opportunities to join the trend, which is bearish? Meaning, how can we find high time frame structural points to give us a safe sell opportunity? Since it's a game of probability, we would want to make sure that we find ourselves in a place that gives us a much better advantage. If we go wrong, we would lose only little, or rather we would incur expenses, because I told you to refer to everything you see as expenses. Now, when price came to the structural points, this is where you come back to look at candlestick formations and then take your trade based on that. There's something we call breakout. There's something we call false breakout. Now, when price came, as you can see, it tested this zone, and then we started having weak rejections. When I treated the psychology of candlesticks, I told you that when you see a candle form, opens and close, and makes a high, make a low, you have to look at how the candle was formed, how it made the high, how it made the low, how it closed. That would give you an idea of what is happening. Either the buyers are much more in control or the sellers are much more in control. So there is a common saying in trading: never buy at support, never sell. Never sell at support, never buy at resistance. Okay, why? Because normally, if a place is a resistance, normally sellers are more prominent in that place, meaning they would want to push price downwards. If price is a demand zone or a support zone, buyers are more prominent in that zone, and buyers would normally want to push price upwards. Some of you might be wondering, what the hell is a support? What the hell is a resistance? Calm down. I will talk about that. Now, since I told you it's about finding out the strategy that you can literally use by finding out higher time frame structural points and then waiting for price to that structure to come or approach to that structural point, then coming down to the lower time frame to look at how price is behaving towards that structural point. And once you see that price wants to obey that structural point, you then take a trade supporting that structural point. Once you see price is trying to disobey that structural point, you then take a trade to counter the structural point. Now, this is a structural point that is clearly more inclined towards pushing price downwards, meaning selling, continuing to sell the price or to short the price. So this is just the toolbar that represents selling. Please just a moment. Now, this isn't how I analyze. I just want to help you guys understand something. Now, this is a high time frame structural point. When price came to a high time frame structural point, what did we see? Well, we kept seeing weak rejections. And in fact, structure was broken to the downside. And when structure tried to regain strength and go back up, this, goodness God, I need to take this very, very slow with you. God. All right, let me just go back to the slide. But very quickly, for those of you that are intermediaries, let me say this. Okay, when we made a higher low, higher high, higher low, higher high, higher low, higher high, the higher high couldn't break this structure. What did it do? It broke down this structure. So this structure that made the higher high was broken. So it's telling you that there is a sign that price wants to come down. Okay, there's a sign that price wants to come down. Now, since this is the structure that broke, that made this move, what you want to see before you negate your idea is you want to see this structure get broken. Okay, this structure that made this move, you want to see it get broken. And when price came, in fact, this structure wasn't broken, but only a wick. By a wick, what we call manipulation, and it's a normal thing to grab what I call liquidity. So if this is a previous high, definitely there are orders sitting at the top. Please calm down. If you don't understand what I'm saying, I shall explain it even more and more. Now, this is targeted at the intermediaries. Now, this high that was made, as you can see, it wasn't broken, but it was tested with a wick. And this wick is simply just manipulation to grab liquidity that is at the top and then continue to push price downwards. As you can see, this high wasn't broken, but then the move, the leg that made this move here was in fact broken. So it's very safe for us to look for sells now. And if we look for sell, well, now isn't a time that ordinarily we would enter a trade because the power of time on price, we should try to make sure the power of time on price is in our favor. Now, if you are an inexperienced trader, you could decide to move your stop loss here above the previous high, or rather the structural point high. Or if you've seen liquidity taken, for those of you that are intermediaries, I think we'll fix a time and talk about this. So yeah, I think if things do go wrong, then we just get, God, just look at this. We spoke about RR, risk to reward. Now, guys, what you see here at the top, this is what we are risking. And what you see here, this blue space, is what we are aiming for. So if what we risk is, let's say, $10 or 10 pips, averagely, we are looking for 70 pips. So I think it's a good bargain for me to risk 10 Naira and try to make 70 Naira, or for me to risk 100 Naira and try to make 700 Naira. It's a very good, because just look at this. The risk to reward says 7.62. So what we are literally risking here is almost 1 to 8 R. So if we've risked 1,000, what we are aiming for is 8,000. And as you can see, just look at this, price is currently coming down. Just look at this, price is currently dipping. So this is a setup that personally I have mastered and I know how to take this trade. But I have disciplined myself to never take trade around this time. Just look at this. Just look, prices. So this would have been a winning trade now. So if I had traded a live account now and I placed the sell, this would have been a winning trade. So I would have currently been running in profit, just like that. All right. Of course, it's not as easy as this because there are other psychological constraints that might hinder us. But yeah, all like God, if you want to give up, I pity you, honestly. If you want to, like, there's so much noise around the market. What you really need, what I've written down here, wallah, is enough for you to make money in this market. What I've written down here, if you can understand all of these things and just stick with them, chicken, it's enough. All right. Now, very quickly, market structure, top-down time frames, top-down analysis. These three here, people spend years trying to understand these things. These three. If Umar is here, he would testify to what I'm saying. Umar, Farouk, are you here?
Yeah, I'm
Farouk,
here. I'm
please
here. I'm
unmute your
here.
mic and testify to what I'm saying. Is
I
making
can hear you.
sense of time frames and is making sense of time frames and doing a top-down analysis, understanding the factor of the price. Is it an easy thing? You are an intermediary, you
Focus.
know what I'm talking about.
I can hear you. Like you were saying something
Can you
about
hear me?
making. Yes, I can hear you now.
Yeah. My
Yes.
question is market structure, and then the factor nature of price, and then
Yep.
switching through multiple time frames, sense of it, conducting a top-down analysis.
Yes.
Is it an easy task?
No, 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 no.
Do you think it's an easy task?
No.
Okay. So now Farouk says it's not an easy task, but honestly, in my opinion, it's an easy task if you would calm down, if you would get someone to just explain it to you in a way that, let's say, the Russian dolls are a thing. So you do understand that the Russian dolls are all the same despite the size. So in terms of trading, what you want to do is you want to come to higher time frames, identify your structural points. Now these are the structural points of what? Of higher time frame. Because anything in between those structural points would be just noise and distraction. And I did switch through from a higher time frame to a lower time frame earlier. I did switch through from a higher time frame to a lower time frame earlier. And you have seen what happened. You have seen what happened because when I drew the line from this structural point to here on a high time frame, just a minute, because when I switched through from a higher time frame to a lower time frame, from this structural point to this structural point, what we see here is a simple, clear, impulsive moves to the upside. Clear, impulsive moves that show the market is moving up. But when we switched through to a lower time frame, we kept seeing noise. We kept seeing different structures forming, insinuating the market wants to come down. Now, look at this very clear. Look at this very clear. Can you guys all see? Can you guys see? You see, boom, impulsive move to the upside. No noise, no nothing. Clear. Now, this is the 4-hour time frame. It's the medium time frame. Now, let me come to a lower time frame. Let's say the 3 minutes time frame. It's loading up. It's loading up. It's loading up. Just a minute. Please, what do you see? How to know that it's the same leg is I drew a line, this blue line. So I hope that doesn't confuse you. It's just a minute, just a minute, just a minute. I drew a line. I drew a line. On the higher time frame, it insinuated the market only went up like boom with an impulsive move. But when we came to lower time frame, just look at this noise, this zigzag. It's going up, it's coming down, it's going up, it's coming down, it's going up, it's coming down, it's going up, it's coming down. So if you get stuck on the lower time frame, you might get a false signal telling you the market wants to come down. When in fact, on the higher time frame, it wants to continue going up. So knowing how to switch through time frames is a very, very important thing. It's a very, very important thing. I would tell you this as a kicker for those just joining and for those that are intermediaries. Never mess with the 4-hour time frame. This is a bonus. Never fucking mess with the 4-hour time frame. Literally just go into the 4-hour time frame straight, seeing what it does, come into lower time frame to take your entry, can save you from so much stress. So sweet boy, you're just joining Farouk, you are also here, and to any intermediary that's here, 4-hour is golden. I told you the secret of the market is what I intend to share with you. 4-hour is the time frame that every one of these freaking guys looks at. So regardless of what you do, who you are, you look at the 4-hour. If you are an institution, you look at the 4-hour. If you are a government, you look at the 4-hour. If you are a hedge fund, you look at the 4-hour. So they all look at the 4-hour and they all make trading decisions based on 4-hour, using what 4-hour is saying. So you'd want to do what the big guys are doing. Since they are all interested in the 4-hour, you should also make sure you are interested in the 4-hour. If you haven't learned anything in this bootcamp, never mess with the 4-hour time frame. For those of you that are intermediaries, for those of you that are coming up, of course, have it at the back of your mind. So yeah, a perfect masterclass to help you make sense of prices. Come to 4-hour, identify structural points, wait for price to come to those structural points, and look for entry on the lower time frame when price approaches those structural points. So yeah, there are many ways, many criteria. When I wrote this PD arrays and entry models, of course, there are other factors to an entry. There are other factors to factor in out. There are other concepts to factor in before making an entry. What an entry is simply you executing, you entering the trade. So it's a self-explanatory term. Now I've just explained time frames, top-down analysis to a point, and I've told you what a market structure is, and I've told you in our previous class, of course, I told you what a market structure is. I told you market structure are of two types. We have a trending market structure, just like this, and we have a consolidating market structure. Now, just a minute. What I keep switching through is what we call the time frame. So the time frames are like the Russian dolls, which I showed you earlier. They are all the same thing, but then the way they say what they say might differ because the high time frames might have lesser noise because they are big boys, and the lower time frames might have so much noise. It's just like you and your baby. You are the same, but then you are more composed than your baby. But your DNA, you share the same DNA as your baby because you gave birth to your baby. But then your baby is more unkempt and noisy than you. So yeah, time frames are of three types: the higher, the medium, and the lower. They are all the same, but the higher has much more maturity and lesser noise. The lower has so much noise, but it doesn't make it any not part of, or rather different from the higher time frame. Now, I told you market structures are of three types at any given time, are of two types at any given time in the market. Either a market is trending or it's consolidating. Now, trending could be trending upwards like this. This is clearly an uptrend move, or it could be trending downwards like this, because this is clearly a downtrend move, or consolidating. or consolidating. Now I'll show you what consolidating is. Now this is a new TradingView application, so that's why most of these things are all messed up. I really don't know where's the rectangle. So where's the rectangle? It's just a minute. Just a minute, just a minute, just a minute. Where is it? Where on earth is this thing? Now what you see here is a consolidating market structure. Another one is here. Let's look at this. Or rather ranging. Just look at this. From here to here. Please forgive the ugly notations, forgive the ugly drawings. Now, from here to here, this is a consolidated market because it's not giving us a clear direction of what it's doing. It's going up, it's coming down, it's going up, it's not going up, until it finally came here and then it broke downwards. That's when it gave us a clear direction of what it wants to do. So this is where element to a trade setup comes in. The market moves in 3 phases, which is accumulation, manipulation, and distribution. Accumulation, manipulation, and distribution. It's just the same way as a human being. You sleep, you eat, you wake up, you work, you sleep, you eat, you wake up, you work. That's how the market also operates. Accumulation, manipulation, then distribution. This is accumulation, this is manipulation, and this is distribution. I'll show you another example. This is accumulation. Here, let's look at it. 1, 2, 3, 4, 5. Accumulation, then we had a manipulation to the upside, then we had a distribution to the downside. I'll show you another example. We had a accumulation here. It's choppy. Then we had a manipulation to the downside. Then we had a distribution to the upside. I'll show you another example. Here, we had an accumulation. Then we had a little manipulation to the downside. Then we had distribution to the upside. The same here. We had an accumulation. Then we had a manipulation to the downside. And we had an impulsive move to the upside. The same here. We had an accumulation. And then we had a manipulation to the upside. And we had distribution to the downside. Now, the manipulation need not be in the opposite God. I hope you guys are following. Please just look at this. Here, we had an accumulation, or rather ranging market structure, and we had a manipulation to the upside, and we had a distribution to the downside. Now, this isn't always accurate, but then most of the time, by solely relying on this, you could literally make money every week. Not every day, but every week. That's to say you are a hunter and you are willing to wait for certain things to play out before you take advantage. You take advantage. So, yeah. Please, this is a new TradingView account. I really don't know where those. Where are they? It's just a minute. Now, to give you an example, to give you a sense of what I mean, let me change this just a minute. To give you an example of what I mean by accumulation, manipulation, distribution. Hey, how can I use this thing? Please wait. Okay, just a minute. Just a minute. I don't die. I don't die. Why I can use this thing? God. Please let me go back to that whiteboard and just do my drawing because this thing is giving me a headache. Now, of course, market structure is of 3 types. Either a trending market structure, or sorry, of two types, either a trending market structure, meaning either trending upwards or downwards here, or downwards, or ranging at any given time. So whenever the market is ranging, a wise person is expected to stay away. Because there's something we call liquidity pools. We as smart money traders, of course, there are different strategy, different ways of looking at the market. But as smart money traders, we are made to believe there are certain stop orders here at the top, or rather liquidity. This is so complex now. Maybe I'll take another time to explain it. And just know this, market structure is of two types, either trending upwards or downwards, or consolidating. Sorry, just like you see here. Now this is consolidation, choppy market structure. Now this is a trending market structure, but an uptrend market structure. This is a downtrend market structure. Okay, a bearish market structure. So yeah, back to my whiteboard. So we've spoken about market structure, and every single thing you see here is what we call price action. Every single thing you see here is what we call price action. There are many other factors you need to consider in between. Stuff like break of structure. Because I told you, a trend moves impulse, correction, impulse, correction, impulse, correction. And when an impulse is made and a correction is made, the next impulse is supposed to break the previous high. And this is a previous high. For us to call it a break of structure. This correction is supposed to make an impulse that will break the previous high, which we call break of structure. And this is supposed to this correction is supposed to break this previous high for us to consider this a break of structure and a continuation of the trend. I'll show you that on the chart. Let's look at this. When we first had a structure here, this is a structure. Please just a minute. Let me zoom it out. Guys, this is a structure. This is a structure. And this is an impulse. So this was from here to here is an impulse. Then we had a correction. Okay? Then we had an impulse. Okay? Then we had an impulse that was supposed to be a correction, but it turned out to be an impulse. So when it was in fact an impulse, it broke the structure of the previous impulse or the previous high. So when it broke this structure, it signaled to us a reversal, because initially, just look at this, the trend was what? Was coming down. It was a bearish trend. Initially, from here, the market continued coming down. And I told you, if we do identify a bearish trend or a bullish trend, the question we need to ask ourselves is, how can we find a way to join the trend? Okay, how can we find a way to join the trend? Now, this is clearly bearish. So every single thing we are supposed to look for should be a sell position to continue taking the market downwards. And how do we do that? I told you we come to the higher time frame, we identify structural points, and we wait for price to come to that structural point, and then take our trade from those structural points. Now, if you can notice, this here is a structural point. When price came back to the structural point, did you notice that we had a bearish candle form? Now, this bearish candle could have signaled to some people that the market wants to continue going down. But after the bearish candle closed, the 1 hour bearish candle closed, what happened? We had a bullish pump. We had a bullish impulsive move. Boom. So that's the intention of the market, to always deceive and con and take advantage of people. But of course, we don't get mad whenever we happen to find ourselves at the wrong side of the market, because we are supposed to pay expenses, not losses. So it's fine. So if the market is trending downwards and you intend to take a sell position, and then you happen to get stopped out because the market continued going up, then it's no problem. So this is where the power of identifying POIs comes in. Because I know as a sharp guy, you are supposed to keep in mind that price is currently at a POI. Oh my God, what's happening? As a sharp guy, you are supposed to keep in mind that price is currently at a POI. Now this is clearly an order block. Please forgive the drawing. It's really unhygienic, but next time I'll use my own personal trading view, and all the tools are much more clean and customized. So the chart will be much more cleaner than this. Now there is an order block here. There is an order block here. Here. This is an order block. I'll tell you what an order block is. So if price is approaching an order block or supply or demand zone, we don't necessarily say definitely price must obey that supply or demand zone. No. Our intention is to mark out the POI, point of interest, and try to see what price does around that POI, and then make a decision based on that. Okay, and make a decision based on that. That's why it's very unadvisable to use phones to trade, because it's very unlikely that if you're using a phone, you will see all of these things. Well, on God, this would have been a perfect trade opportunity for me, because this here is a very liquid. Oh God. Guy. Oh, oh, please just a minute. Like trading, it doesn't have to be difficult. Honestly, it doesn't have to be difficult. The parameters I'm giving you now, if you could just understand them and just stick with them is enough. Is enough. I have taken this trade before, and I think I sent it to the group of USD JPY. When the session is over, um, I will point your attention to that trade. I will send it again to prove to you what I'm saying. So market by its very nature is repetitive. Okay, it's repetitive. It normally repeats itself. Same thing, same price action, but different pair. Just a minute. Let me put some demarcation here. Just a minute. I will show you the same thing happened. The same thing. Exact same thing. Please just a minute. Just look at this. Here we had a break of structure that signaled a sell bearish strength, that signaled bearish strength. Here we had a break of structure. Here, just a minute, guys, just a minute. Just here we had a break of structure. Here. Here we had liquidity. Here we had liquidity. Here we had momentum. Please, just a minute. I'm trying to prove something to you, which when I sent to the group, I told you is the same thing. Momentum. Just a minute, guys. Just a minute. Now, what we had here was a break of structure. Here break of structure, here break of structure, here break of structure. Then we had an equal low, which is simply a sign of liquidity being engineered. Price came down and took that liquidity, and after taking the liquidity, it then reacted to this order block, and then it went back up, took this momentum trendline liquidity, and then went absolutely berserk upwards. I will show you this. I sent it to the group. The same thing on USD JPY. Now I'll very quickly explain anatomy of a market structure again. Here, this is a structural high. This is a structural low. This is a structural high. This is a structural low. This is a structural high. This is a structural low. Correction, impulse, correction. We then expected an impulse downwards, but then this is a very important high probability POI. Price had no choice but to pump upwards. Okay, so by breaking this zone, it signals to us that boom, we have a change of trend. We call it change of character. And then when it took out this trend line, this momentum trend line liquidity, and took out these highs, we then have a new structural high or new structural POI. A new structural POI. Meaning here was previously resistance, but now it has turned into support. Please, what happened? When price broke this resistance here, it came down and it tested the support and then continued going upwards. So we call it break, retest, and continuation. BRC, break, retest, and continuation. What happened? Very quickly, just look at this. We broke it, then we retested it, then we continued. Perfect. So back to what I was saying about structural points. For you to identify and know that trend wants to continue is when you keep seeing structural points getting broken, then that's a sign that trend wants to continue. Because we had a structural point here, we had a structural high here, we had a structural high here, structural low here, then boom, we broke this structural high. Okay, then we had a retracement. The retracement we had did not break this structural low. Rather, it only wicked below it. It only wicked below it and took out liquidity and then continued going upwards. I told you we did that anatomy of a candlestick. We did the psychology behind the candlestick. When candlestick form, what is it saying? You don't necessarily single out candlesticks. I wrote it down here. Trend is greater than candlestick. So you don't necessarily just single out candlesticks and say, well, a candlestick pattern, a doji formed here, so I'm doing this. No. You want to put into consideration what a candlestick is saying when it approaches a POI. That's when to rather single out candlestick and pay attention to what it's saying. So the structural low here wasn't broken, rather it was wicked. And the wick was simply to grab out the liquidity. We call it the buy side liquidity or sell side liquidity. I will explain what liquidity is and respect this order block. We call it the breaker block. When I reach the entry models, we'll talk about it. After which price, boom, skyrocketed up. And then when price came to this POI again, what happened? We started seeing wick rejections. This high wasn't broken, but it was wicked. And a wick is simply a sign of liquidity grab to tell you that price wants to continue going downwards. Please, what did price do? Boom, it continued going downwards. So guys, just calm down, calm fucking down. It's very, very simple. I promise you, we still have 20-something days to go. So these things would make sense. Little by little, we are making progress. I want you to be conversant with these terms, Little by little, I will take you to the chart. Kadan, small, you guys will know what I'm saying. But for the most part, have this at the back of your mind. Go to higher time frame, identify structural points, wait for those structural points to get tested, try to see how the candlesticks form around those structural points, and make your decision based on that, whether to join the pro trend or a counter trend. And the perfect way to join a counter trend is when a zone gets broken, you wait for it to get retested for you to enter again at retest, which I just showed to you here. This zone was broken. This was a resistance zone, it was broken, and here it was retested, so you entered. So if it was broken and it was here, and then you entered here, the fact that it made a corrective move would have scared you and frightened you, and you would have closed at a loss, because I don't think you have the courage to take an entry here and put your stop loss here. That's just ridiculous. It's ridiculous. Just look at this. So the concept of refinement, once we get to the concept of refinement, you will see what I'm talking about. How to take trades with little downside potentials. How to take trades with little downside potentials. It's just a minute. How to take trades with little downside potential. So how do I put myself in situations that I want to, why is this thing doing me nonsense? It's just a minute. Long. So if this is your zone and you find out that the zone gets broken, what you do is you wait for a retest, then you enter. So this is where the concept of break and retest comes in, and the concept of conservative and aggressive comes in. If you are an aggressive trader, as soon as this was broken, you would enter, meaning you would enter around here. And if you enter around here, the concept of risk management or trade management always suggests you put your stop loss at previous structural high or low, below or above previous structural high or low. Now, if you enter here, since you are inclined to put your stop loss below previous structural high or low, and this is the previous structural low. So you would have put your stop loss here. And when price came down to retest the area that was broken, what happened? You got stopped out. Just look at this. This here stopped you out, because I don't think you would have it in you to enter a trade here and then put your stop loss here. It's very unlikely. Now, if you are an aggressive trader, this is what you would have done. You would have entered here and put your stop loss here. Please just look at the wideness, the margin. So if things go wrong, you would have lost so much more than myself, that I'm a conservative someone. I know how to wait. And if things go wrong, I will only lose just a little here. But you, if things go wrong, you will lose from here to here. So if you are losing $1,000, maybe I'm only losing $100. So I'm smarter than you. So it's not just about taking profit, it's also about knowing how to enter trades and manage them. Now, and if things go right, of course, I also stand a chance to gain more than you, because my profit would commence from here up to here. But your profits would commence from here to here. So just look at this. My trade is a 1 to 6.2 risk to reward. Your trade is a 1. Your trade isn't even 1 to 2 risk to reward trade. So when I'm risking 10, or when I'm risking 100 to aim for 700, you are risking 500 to aim for 500, or you're caught. It doesn't even make sense. So by mere looking at these two people, you can tell who is the smartest person. You can tell who is the smartest person. This person has a chance to gain more because he has an understanding of risk to reward. I told you about premium and discount yesterday. The aim isn't to buy at an expensive price. The aim is to wait and buy at a much cheaper price. And the retest of that zone that was broken is your tendency to buy at a cheaper price, since price moves in waves, in impulse and corrective phases. So if we have an impulse, we have a correction, we have an impulse. If we want to buy, we don't buy at the impulse, we buy at the correction. Then we buy here, then it continues going up. But if you buy here, if price decides to make a correction, you will be panicking. For me, if I buy here, most likely price is only likely to just make a little and continue going upwards. So don't worry if you are new. If it's seemingly confusing, just calm down, calm down, calm down. We still have time. So I have successfully mentioned market structure. I have successfully showed you what a break of structure is, and I have successfully showed you what a change of character is. I didn't just denote it. But what a change of character is let's assume price is going down, it's going down, it's going down, it's going down, and then it breaks a previous high. So instead of continue going downwards, it went up rather and broke this high. So this is signaling to you a sign of reversal. So from downwards, we are likely to go upwards. So after breaking this previous high, the trend now changes. Okay, after breaking this previous high, the trend now changes. So what we are likely to expect now is a bullish entry. Okay, a bullish opportunity, an opportunity to buy is what we are likely to watch out for. Okay, previously the trend was coming downwards, but since price by its very nature is supposed to make an impulse, correction, impulse, correction, impulse, correction, and impulse, but it made an impulse, correction, impulse, correction, impulse, this should be protected. This should be protected. So this wasn't protected, it was broken. So this is signaling to you that there is a sign of reversal. And if this gets broken, the first place you are supposed to watch out for as a POI is the zone here that gets broken, because price might decide to test it and continue going upwards. Or decide to retest an area, something here, so there are things we call order blocks. I will tell you about order blocks, just calm down, we still have 20 something days, so yeah, calm down, before continue going upwards. These are all entry models, PD arrays, which we shall talk about. The day we'll focus more on liquidity, I will tell you how to spot these things. So yeah, price action by its very nature, since market structure is of a trending market structure and a ranging market structure, price action is of two types. Is of efficient price action and an inefficient price action. What does that mean? Normally, buying, selling, buying, selling, buying, selling, buying, selling. Now, this is efficiency. There's balance. There's equilibrium. Everyone is given a fair chance to participate in the market. But if we have buys without seeing sell candles prominent, so that's telling you there's a sign of an inefficiency. So if we have buys, we expect to have sells to balance the equation. Okay, so how do we identify efficient price action from an inefficient price action? There are certain candlesticks we call imbalance candlesticks. These candlesticks are simply characterized by huge moves, large moves. For instance, this. Please just look at this. Isn't this a large bearish move? Of course, it is. And by no means would you say this is a just move. Definitely, this isn't an efficient price action. What we want to see is something like this. Something like this. Buy, sell, buy, sell, buy, sell, buy, sell. Buy, sell, buy, sell, buy, sell. So whenever we have an inefficient price action, either of a sell side or a buy side, let me find a buy side inefficient price action, please. Just a minute. Let me find a buy side. And now this is a buy side inefficient price action because boom, we had a bullish move upwards. So how do you react and respond to these inefficiencies? We call them liquidity voids, fair value gaps, inefficiency. There's this concept I hear ICT people calling me. I don't want to complicate things for myself. But yeah, since by its very nature, price is expected to be efficient, if we have sells, we want to see buys. And if we have buys, we want to see sells. So whenever we experience an impulsive move of a singular candle, we refer to that as an inefficient price action. So by its very nature, price is supposed and expected to rebalance itself. Because as a human being, if you raise your left foot, we expect you to also raise your right foot. If you raise your left foot, we expect you to also raise your right foot. So when you raise your right foot and throw it up, you can't keep your right foot that way now. Definitely, you have to pick your left foot to balance that your move. That's the only way you would walk. That's the only way you would seem a normal human being, a balanced human being. Okay, so same applies to price. Whenever you see a move of a bullish candle, impulsive bullish candles, huge bullish candles, without the opposite candles of bearish candles, expect that thing to get balanced sooner or later. And that's what we had here. When price tries to rebalance itself, there are times it instantly rebalances itself before continuing, and there are times that it comes back later on. Now, just look at this. Just look at this. We had this move. We had this imbalanced move. Just look at this here. Please, I really don't know where the rectangle is. We had this move to correct this imbalance. This move here. Price came back. After making this move, price came back to balance this move. Okay? Left leg, right leg. So it's now balanced. And the reason why we had this move is, well, this is an order block and there is liquidity sitting above it. And there are two types of liquidities. There are hidden liquidities and there are visible liquidities, which I shall talk to you about. Guys, just calm down. Honestly, if you guys are writing down what I'm saying and you guys are actually understanding what I'm saying, I swear to God, this one that I'm swearing. So, but yeah, this is an example of an efficient price action. And this is an example of an inefficient price action. How to utilize these imbalances, we call them imbalances or FVGs. There are different ways of utilizing them. And as we forge ahead, we still have 20-something days, God willing. We'll talk about them. We'll talk about order blocks, talk about FVGs, we'll talk about support and resistance, we'll talk about supply and demand. We'll talk about that, God willing. God willing. But yeah. So I've spoken about trading ranges, I've spoken about POIs, I've spoken about confluences and conformations in a way, because confluence is when you let's say just a minute. Confluence is simply this. We had a bearish move, we had a liquidity area that was taken, and we had a very clean demand zone, and price respected that demand zone by breaking the previous structure that pushed price to the demand zone. And this is the structure. This is the structure. It was broken. In fact, after getting broken, it even took out the previous highs and the momentum trend line liquidity. I will tell you, we'll talk about how to identify liquidity zones, and turned resistance into support. Because when price retested the resistance that was turned into support, we had an engulfing candle. Please just look at this engulfing candle. Just look at this one. Boom, it formed. We had engulfing candles formed. Of course, yeah, just look at this. We had a bullish engulfing candle form. And then this bearish candle that formed, I don't know why it formed. I really don't know why it formed. Maybe when I go to lower time frames, I can make sense of it. But yeah, we had a bullish engulfing candle form at a resistance that were turned into support as a break and retest trade pattern or entry pattern. Then boom, you enter. So very easily, you had a 1 to 7 risk to reward trade. If you are someone that can hold trades even for if you are someone that can hold trades, this would have been, you would have held the trade to this area. So this liquidity pool. So it would have been easily 1 to 9 risk to reward trade. So this is simply a way. Don't worry, guys. This is the first time you are hearing about these things. So I don't expect you to crack every single code. So yeah, confluences and confirmations. There are different ways to, depending on the strategy you use. And then of course, after executing, where trade management comes in is, well, you've executed here, and once price broke this area, you then break even. And once price breaks this area, it then gives you confidence that it wants to continue pushing upwards. So you can come here and put your trail stop, because this is the previous low, and when price came down, it didn't try to mess with this previous low, so your stop loss would have been really safe, and it continued. When price broke this area and went up, you can come here and place your stop loss to then trail it. But then trail stops are not really useful for some people because they are so confident, because they're things we call manipulation, because something could just happen and a wick would just decide to and then continue going upwards. So you could be like, what the hell just happened? I just got stopped out. So yeah, it depends on the type of person you are. Certain people would be taking partials along each structural point. So once price reaches this structural point, they will take partial. Once price reaches the structural point, they will take partial. So little by little, before you know it, they've taken everything. They call it pay the trader. So don't worry, guys. This is the first time. This is the first time. So yeah, you have pro-trend trades and counter-trend trades. Pro-trends are simply, you identify a trade is bullish, you find a way to buy. You identify a trend is bearish, you find a way to sell. Okay, so these are all counter and pro-trend trades examples. And in terms of the conservative and aggressive, I've given you an example of two people here. This person is an aggressive trader. Once we had a breakout, boom, he just entered. And the second person, whom is a conservative trader, waited for a retest of that zone before entering. Now, there are different advantages and disadvantages to these two types of traders, because as a conservative trader, price could decide not to retest this zone and continue spiraling up, and you could have just missed the entry. But as an aggressive trader, and you could have just entered, and that's it, you won. But as an aggressive trader, you entered here, and that gave you room for so much risk, and that's not what we want. What we want is minimal risk and high returns. That's the smart thing to do. Okay, imagine finding yourself in situations that you either become rich or you die. So that's not a good bargain. What you want is you either become rich or you get given another opportunity to try again the next day. Okay, so if you are an aggressive trader, you find yourself in situations that either we become rich or we go back to the village. But as a conservative trader, I find myself in situations that either I become rich or I get another opportunity to try again tomorrow. So choose your spec, choose whom you want to become. Oh God. Yeah, I've spoken about imbalances because when I spoke about efficient price action and inefficient price action, I told you what an imbalance is. So whenever we have an inefficient price action, by having too much of a particular candle, either bullish candle or selling candle or bearish candles, that's what we refer to as imbalances. And imbalances, by their very nature, imbalance. Therefore, price would try to rebalance those imbalances. So when you have an imbalance, we expect a rebalance to happen. So yeah, and then those rebalances are usually sometimes instant, sometimes they happen at later times. Price would come back at a later time to rebalance those imbalances, because what it means is the institutions have placed a singular order of a particular instrument, and that's not how commerce happens. Whenever there's a buy order, we expect a sell order to pair it up. So when we have too much of a particular order, it means that they are the only ones putting up a purchase, a bargain on that order, on that instrument. And that's not good. So when you sell pure water, we want to see people buying your pure water. When you sell textiles, we want to see people buying your textile. Okay? When people buy your textile, we want to see people that are selling textiles. When people buy textile, we want to see people selling textiles. That's how to get balance. So that's the concept of imbalances very briefly. And supply and demand zone is simply, I told you a chart is like this. And there are two people on the chart. They are the buyers and they are the sellers of an instrument that is normally at this left hand side of the chart, which I shall show you here. This is a chart, my friends. And this here, this is the instrument. And these
Omo, wetin happen now?
I think maybe the system shut down,
Okay.
or rather,
Or maybe he tried to get rich. Then on his way to get
This
rich, he
system
died.
wahala. This system wahala don
the network shut down. I don't know what.
kai.
Omo,